There is a quiet machine moving money through the market right now, and most people do not understand how it works. That machine is not emotional. It does not care what the headlines say. It does not care what retail investors are excited about on social media. It moves based on incentives, structure, liquidity, and flows. And when you do not understand that machine, you can look at the market every day and still miss what is actually happening. Money is silently rotating out of the sectors that everyone is already talking about. At the same time, it is beginning to move into areas that most individual investors have never seriously studied. That is important because in markets, the biggest risk is often not that you are wrong about the world. The bigger risk is that you are looking in the same place as everyone else while the real shift is happening somewhere else. If you miss that rotation, you can spend the next year watching the index move sideways, feeling like nothing is happening, while a small group of stocks quietly moves far ahead of the market. If you catch it responsibly, you do not need to gamble on meme stocks. You do not need to chase what is already euphoric. You simply give yourself a better probability of being positioned where the next flow of capital is going. That is how I think about markets. I do not start with a stock tip. I do not start with excitement. I do not start by asking which company everyone on television is discussing today. I start with a system. By the time I finish explaining this, you will understand why the biggest stocks keep getting bigger, why the index itself has become structurally tilted in their favor, and why the smart thing is not always to predict the next winner, but to follow where money is actually moving between sectors. And then I will show you the two areas I am watching most closely, the specific kinds of companies inside those areas, and the exact tickers that fit the framework. Not because I want you to blindly buy anything. That is not how good decisions are made. I want you to understand the operating system behind the decision. The first thing to understand is macro, but I want to make macro simple because most people make it sound more complicated than it has to be. Think about the economy and the stock market as a weather system. There are sunny periods when liquidity is abundant, risk appetite is high, and almost every asset appears to rise together. There are cloudy periods when uncertainty rises, policy becomes tighter or less predictable, and different parts of the market begin to behave very differently. There are storm periods when inflation, rates, geopolitics, energy, debt, and policy all interact at the same time. And the people who thought investing was just buying whatever was popular suddenly find out that their process was not really a process. Your job as an investor is not to predict the weather perfectly. That is impossible. Your job is to dress for the weather that is actually in front of you. That distinction matters. Right now, the weather is not the same as it was in 2021. In 2021, nearly everything went up. You could buy a great company, an average company, or a speculative idea with no durable economics. And for a period of time, it could still look like you were a genius. That was not because everyone suddenly became a great investor. It was because the system was full of liquidity and the cost of money was extremely favorable for risk assets. But that is not the world we are in now. Now, inflation still matters. Rates may not come down as quickly as many people want. Governments are spending, central banks are making difficult choices. Geopolitics is not calm. Energy is not simple. Oil, defense, minerals, supply chains, debt, and fiscal policy are all part of the environment. When that happens, what you own starts to matter more than simply when you own it. In a broad liquidity boom, timing can make almost anything look good for a while. In a more selective market, ownership matters. Different sectors need different clothing for different weather. Some businesses do well when money is cheap and growth narratives are rewarded. Some businesses do well when the world becomes more physical, more energy intensive, more resource constrained, and more concerned about security. That is why this moment is so important. A lot of people are still acting as if the only thing that matters is whether the index goes up. But the real market is not one thing. It is a set of flows. Money moves between sectors, it moves between themes, it moves between crowded trades and ignored trades. It moves from expensive to cheaper, from obvious to less obvious, from what has already worked to what may be beginning to work. If you understand that, you stop looking at the market like a casino and start looking at it like a dynamic system. Now let us talk about the index, because this is where many individual investors misunderstand what they actually own. Most people have heard of the S&P 500. They think of it as a broad index of 500 large American companies in one sense. That is true. But structurally, the S&P 500 is not 500 companies equally sharing your money. It is market cap weighted. That means the bigger the company, the larger its weight in the index, and the larger its weight in the index, the more money automatically flows into it whenever people buy the index. That creates a flywheel. If one company is much larger than another company, then a far greater share of every passive dollar goes into the bigger company. If the bigger company keeps going up, it becomes an even larger percentage of the index, and then even more of the next passive dollar goes into it. That is not a conspiracy, it is a mechanism. But mechanisms create outcomes whether people understand them or not. When pension plans, retirement accounts, 401(k)s, ETFs, and passive funds keep directing money into the same market cap weighted structure, automatic demand keeps flowing into the largest companies. That is why the biggest stocks can keep getting bigger for a long time. It is also why the index can become less diversified than people believe. When the top 10 companies represent roughly 40% of the index, while the other 490 companies share the rest, you are no longer buying the kind of diversification many people imagine. You are buying a very concentrated exposure wrapped in the language of broad market investing that can work very well when the largest companies are winning. It has worked very well during periods when companies like Microsoft, Amazon, Nvidia, and the other mega caps are leading the market. But it creates a different kind of risk. When those leaders stop leading, the index can feel stuck. You can be invested, you can be doing the thing everyone told you was sensible, and yet your results may depend heavily on a small group of companies continuing to carry the whole structure. That is why sophisticated investors watch concentration. They understand that passive investing is easy, cheap, and convenient. But they also understand that convenience can hide risk. When too much money is forced into the same names can rise faster than expected. Then, if conditions change, they can also fall faster than people expect. This does not mean index investing is bad. It means you need to know what you own. If you are buying an index fund, you are not buying 500 equal bets. You are buying a structure with a strong tilt toward the biggest companies that can be perfectly fine if it matches your goals, your time horizon, and your risk tolerance. But if you do not understand it, you may think you are diversified when you are actually much more concentrated than you realize. That is the first part of the machine. The second part is rotation. The mistake most people make is simple. They wake up, check the news, look at the SP 500, look at the same mega cap stocks everyone else is looking at, and ask what is moving today. That is not how institutional money usually thinks. The educated money is not always sitting still in the same popular names. It is constantly comparing opportunities. It asks where capital is leaving, where capital is entering, what is crowded, what is neglected, what is expensive, what is cheap, what has momentum, and what has a macro tailwind. It rotates. It moves from mega caps to beaten down sectors. It moves from technology to energy. It moves from popular trades to unloved trades. It moves from crowded to uncrowded. It moves from what everyone already sees to what the broader market has not yet fully priced. That is the key lesson. Your job is not to predict which mega cap stock will be the next winner. Your job is to follow the actual flow of money. That sounds simple, but it is not how most people behave. Most people wait until the mainstream narrative becomes obvious. By the time a theme is on every financial news channel, the easy part of the move may already be gone. A better approach is to build a framework. The framework starts with the weather report. Where are we in the world? Not in a complicated academic sense, but in a practical sense. Is energy scarce or abundant? Are rates falling quickly or staying higher for longer? Is inflation fading or staying sticky? Are governments spending more on defense, infrastructure, energy security, and domestic supply chains? Are minerals scarce? Are countries trying to reduce dependence on foreign supply? Are AI data centers increasing the demand for electricity, cooling, and physical infrastructure? You do not need to predict everything. You need to know the direction of the wind. Then you look at sectors. You ask which sectors are filling up with money, which sectors have the strongest tailwinds, which sectors are beginning to show relative strength, which sectors are benefiting from the weather rather than fighting it. You rank them. You do not guess blindly. You do not begin by falling in love with a ticker. You look at where the money is moving. Only after that do you look at individual stocks. That order is critical. Most retail investors start with stocks. They hear a ticker, look at a chart, read a headline, and then try to invent a reason why it should go up. I prefer the opposite. First, understand the environment. Then identify the sectors with money flowing into them. Then find the leaders inside those sectors. That is a much better probability structure. It works in bull markets, sideways markets, and difficult markets because it is based on a principle rather than a mood. Money has to go somewhere even when the broad market looks weak. Capital does not disappear, it rotates. The question is whether you are watching the rotation or staring at the headline index. The first sector that stands out in this framework is oil and gas, machinery, and services. The way to think about it is picks and shovels. In a gold rush, the people who get rich are not always the miners. Often the better business is selling the tools, equipment, transportation, infrastructure, and services that the miners need in order to operate. Energy has a similar structure. There are producers that drill for oil and gas. But behind those producers are companies that sell the machinery, compressors, drilling equipment, tools, services, infrastructure, and technical support that make production possible. When the world needs more energy, when oil and gas infrastructure needs investment, when LNG demand grows, when countries want more storage, more pipelines, more terminals, and more secure supply, the companies selling the picks and shovels can benefit. That is the logic. The world still needs energy. AI requires enormous amounts of energy. Data centers require power, cooling, and physical infrastructure. Geopolitics can disrupt energy flows. Oil prices can influence drilling economics. Liquefied natural gas requires terminals, pipelines, export infrastructure, compressors, and specialized equipment. Energy security is no longer just a market theme. It is a national priority for many countries when choke points become unstable. Countries ask different questions. They ask whether they have enough storage. They ask whether they have enough domestic production. They ask whether they need more pipelines. They ask whether they need more export terminals. They ask whether they are too dependent on one region or one route. Every one of those questions points back to infrastructure, and infrastructure points back to machinery and services. That is why I pay attention to this area. The first company in that group is Baker Hughes, ticker BKR. Baker Hughes is a major oilfield services company. It provides the kind of equipment and services that support oil and gas production and infrastructure. It is a picks and shovels business inside the energy system. The point is not that anyone should buy it because I mention it. That would be the wrong lesson. The point is that it fits the pattern. It sits inside a sector where the macro weather is favorable, where capital is beginning to pay attention, and where infrastructure needs can create real demand. When I look at a company like that, I do not just ask whether the story sounds good. Stories are easy. I ask whether the stock is acting like money is moving into it. Charts are not magic. They are pictures of behavior. They show where buyers have been willing to step in, where sellers have appeared, and whether the price is trapped, weakening, or beginning to break out. One of the patterns I look for is simple. A stock moves sideways for a while. It builds a range. The highs are in the same area. The lows are in the same area. Nothing dramatic appears to be happening. Then, if the stock breaks above the recent highs with strong demand, that can show that the balance between buyers and sellers has changed. That is why professionals often prefer to buy slightly above a breakout rather than slightly below it. To many people, that feels wrong. They say, why would I pay more when I could have bought it cheaper yesterday? The answer is probability. A cheaper price does not always mean a better decision. Sometimes a slightly higher price comes with better evidence that the move has actually begun. That does not eliminate risk, it simply changes the risk and reward setup with BKR. The important thing is not just the company. It is the combination of sector tailwind, institutional interest, and the possibility of a breakout pattern. If that pattern is there, I pay attention. Another company in the same general area is NPK. It is smaller and more specialized. It provides temporary worksite infrastructure for energy and construction projects. That kind of business can sit close to the physical build-out of energy and infrastructure. It is not as obvious to the average investor as a famous technology company. That is exactly why it is worth studying. If a smaller company is in the right sector, has meaningful institutional ownership, has strong analyst interest, and is sitting in a constructive technical pattern, then it deserves a place on the watch list. Again, this is not a command to buy. Stock tips are dangerous because they bypass thinking. The goal is to build a process that tells you when a company deserves attention and when the probability is still not good enough. With a stock like NPK, I would look at whether it has been moving sideways, where the recent highs are, where the recent lows are, and whether price can break above the range. If the recent high is around the level that matters, then I do not need to guess in advance. I can wait for price to show me whether buyers are strong enough to take control. This is one of the hardest ideas for retail investors to accept. Good investing is not always about being early. Sometimes being early means sitting in a position while nothing happens, tying up capital, and taking risk before the evidence is there. A more principled approach is to wait for confirmation, define the risk, size the position correctly, and accept that you may pay a little more in exchange for better odds. That is how I think about it. The second major sector in the framework is critical minerals, mining, uranium, lithium, and rare earth exposure on the surface. That sounds less exciting than artificial intelligence or mega-cap technology. But markets do not reward excitement forever. They reward demand, scarcity, capital flows, and earnings power. The world is becoming more electric. Electric vehicles need lithium and battery materials. Battery storage matters because solar and wind do not produce consistent power every hour of every day. The grid needs modernization. Defense applications need materials, AI data centers need power and cooling, and the infrastructure supporting all of that needs minerals. At the same time, countries do not want to be dependent on adversaries or unstable supply chains for critical resources. When that happens, governments begin to support domestic mineral supply chains. That creates another kind of tailwind. It is not only market demand, it can also become policy demand. The first company in this area is SQM Sociedad Qfamica y Minera de Chile. It is one of the major lithium producers in the world. It has exposure to the lithium supply chain, and the original thesis is tied to increasing demand for batteries, electric vehicles, storage, and a more electrified economy. It is also connected to capacity expansion, including Australian operations and a partnership with Chile's state-owned mining company. The point again is not to fall in love with the ticker. The point is to connect the layers: macro weather first, sector flow second, company leadership third, then price behavior if SQM has been moving sideways and begins to break above a previous high. That is the kind of evidence I want to see. If the prior high is around the level mentioned in the original setup, the reason to pay attention is not because the number itself is magical. It is because the prior high marks a level where supply previously appeared. If price gets above that level and holds, it can show that demand has absorbed the supply. That is a principle. It applies across many markets. The second company in the critical minerals group is Uranium Energy Corp, ticker UEC. The logic here is uranium and nuclear energy. The world wants more electricity. AI data centers add to that demand. Nuclear energy becomes part of the conversation because it can provide large-scale power. The United States also wants domestic uranium supply. It does not want to depend too heavily on foreign sources in the original setup. UEC had started production at a uranium mine in South Texas, described as the first new U.S. uranium production facility to come online in over a decade. It also had 2 active uranium mining operations, one in Wyoming and one in Texas, and processing capacity cited at 4 million pounds of uranium per year. Those are the kinds of details that matter because they connect the story to actual capacity. But even with a compelling story, I still do not want to buy blindly. A stock can have a good story and still be too early. A stock can rally, collapse, build higher lows, and still need time before the pattern is ready. That is why UEC may belong on a watch list before it belongs in a portfolio. There is a big difference between watching and buying. Watching means the thesis is interesting. Buying means the setup, risk, timing, and position size all come together. Most investors confuse those 2 steps. They hear an interesting story and immediately want to act, but markets punish urgency when it is not matched with evidence. The third company in that group is CMP. It is another minerals and rare earth-related play. The important thing is the same pattern. If price is near a breakout area and the prior level is around the level discussed in the setup, then the question becomes whether the stock can prove that buyers are strong enough to push it through. If it cannot, I do nothing. That is a decision too. Not acting is often one of the most important investment decisions. If it can break out, then I look at the risk. Where am I wrong? How much can I lose? How large should the position be? What would tell me the flow is no longer there? Those questions matter more than enthusiasm. Now, let us talk about how to put money to work, because this is where people can destroy themselves even when they have the right idea. A good thesis with bad risk management can still produce a bad outcome. The first rule is position sizing. Only risk what you can afford to lose from the specific bucket of money you are using for this kind of investment. A position is not the same as risk. You might have a position that is larger than 1% of your portfolio, but if the stop or risk point is defined correctly, the amount you are risking may be much smaller. The original framework used the idea of risking a maximum of 1% on a position. That is a sensible way to think, because it keeps one wrong decision from damaging the whole system. The goal is not to be right every time. That is impossible. The goal is to make sure that when you are wrong, the loss is controlled, and when you are right, the gain has room to matter. That is an asymmetry principle. You can also use individual stocks or sector ETFs. Both can be reasonable depending on your skill, time, temperament, and risk tolerance. Individual stocks can offer more specific exposure, but they require more work and more risk control. Sector ETFs can reduce single company risk, but they may also dilute the upside and include companies you would not choose individually. There is no universal answer. There is only fit. Fit means the strategy matches the person using it. Another principle is scaling. Do not throw a large amount of money into something you do not fully understand. Scale in. Learn how the position behaves, see whether the thesis is being confirmed, add only when the evidence improves and the risk remains controlled. The worst mistake is to take a new concept, become excited, and treat it like certainty. Nothing in markets is certain. There are only probabilities, consequences, and decisions. That is why I prefer to look at the stock market as a chessboard. Each square is a sector or industry. One square may be software, another may be uranium, another may be oil and gas services, another may be gold miners, another may be construction, another may be insurance or healthcare. Money moves across that board. It leaves one square and enters another. When money leaves a sector, prices can weaken even if the companies are still good. When money enters a sector, prices can rise even before the broader public fully understands why. That is why the market is not simply one line going up or down. The news often talks about the market as if it were one object. The SP is up, the SP is down, the market is strong, the market is weak. That is too crude. Under the surface, some sectors can be breaking out while the index is doing nothing. Some industries can be accumulating institutional demand while the headline market looks dull. Some areas can be losing leadership while another area is quietly becoming the new leadership group. This is what tactical allocation is about. The large funds, hedge funds, traders, and trained investors do this constantly. They are not always smarter in an absolute sense, but they are trained to watch flows. They know that capital rotates. They know that if money is leaving one place and entering another, the right question is not what the media is discussing. The right question is where the marginal dollar is going next. A position may last a year or two, it may last a month or two. It depends on whether the flow remains present. When the money is there, I am interested. When the money leaves, I leave with it. That is not emotional. That is a rule. This way of thinking can change how you experience a difficult market. If the SP is doing nothing, most people feel stuck. They say the market is bad, so there is nothing to do. But if you are watching sectors, you may see oil and gas service stocks acting well. You may see construction stocks acting well. You may see insurance or healthcare showing strength. You may see electronic components, defense, mining, or other groups taking leadership at different times. The opportunity is not always in the index. Sometimes it is under the surface. The work is to track it. This does not require watching screens all day. It requires having a repeatable process. An hour a week can make a meaningful difference if that hour is structured. Look at the macro weather, rank the sectors, study the leaders, watch the levels, define the risk, size the position, then follow the money. Most people spend 40, 50, or 60 hours a week earning money, especially if they include commuting, stress, and the energy of their working life. Then they spend almost no time learning how to manage the money they worked so hard to earn. That is a bad trade. If you do not develop the skill set, you remain dependent on headlines, tips, and emotion. If you develop the skill set, you begin to see the market differently. You stop asking, what stock should I buy today? You start asking, where is the world in the cycle? Where is capital moving? Which sectors are being accumulated? Which companies lead those sectors? Where is the breakout level? Where is the risk point? How much can I afford to lose if I am wrong? What would tell me the thesis has changed? Those questions are the difference between gambling and decision-making. So the message is simple. There is a quiet machine moving money through markets. The largest stocks have benefited from the index structure and passive flows. That can continue for a while, but it also creates concentration risk. At the same time, capital is always rotating beneath the surface. Right now, the areas worth studying are the physical sectors tied to energy infrastructure, oil and gas machinery, LNG buildout, critical minerals, lithium, uranium, rare earths, grid modernization, defense needs, and the power demands of AI. The specific names in the framework include BKR and NPK on the oil and gas machinery and infrastructure side. They include SQM, UEC, and CMP on the critical minerals and uranium side. But the tickers are not the most important thing. The process is the most important thing. Do not memorize the names and skip the reasoning. That is how retail investors get hurt. Understand the weather, find the sector flow, study the leaders, wait for evidence, manage the risk, then act only when the probability justifies action. The market does not reward people for being busy. It rewards people who understand cause and effect before the crowd does. It rewards people who can think in systems rather than headlines. It rewards people who can distinguish a story from a setup, a watch list from a buy decision, and a cheap price from a good probability. That is the lesson. Follow the money. Do it calmly. Do it with principles. Do it without pretending certainty exists. And remember that the goal is not to be smarter than everyone. The goal is to avoid standing in the wrong place when the flow of capital has already moved somewhere else.